Chapter number 2, Functions of Bank. In this video we are going to study different primary functions of bank. Functions of bank, they are divided into two parts, primary functions and secondary functions. In this diagram you can see. In this video we are going to talk about only primary functions of bank. In next video we will talk about secondary functions. So primary functions, there are two types of primary functions, accepting deposits and granting loans and advances. So let's talk about first type of function of the bank, that is accepting deposits. So commercial banks receive all type of deposits from public. Person who invest their savings to the bank, they are called as the depositors of the bank. Modern banks try to attract depositors from the public by providing different types of deposits accounts. The deposits accepted by the banks are safe and returning on demand by the depositors, and also offer some interest on the deposits. So banks attracts depositors to save and deposit their money with the bank by offering them guaranteed interest on their deposits. There are different types of deposits: demand deposits and time deposits. Demand deposits, they are deposits which are withdrawable on demand. They are having two demand deposits having two types: current deposits and saving deposits. Current accounts are demand deposit accounts that are primarily meant for facilitating settlement of transactions using checks. Current deposits are deposits which can be withdrawn by the depositors as and when they want without any notice. Generally, current accounts are maintained by business entities. Even individual with large number of transactions, he can also maintain current account. Then next is the saving account. Saving deposits are deposits which can be withdrawn by depositors, but there is limit on the total number of withdrawals. For such deposits, if the amount to be withdrawn is large, prior notice is given. It is suitable for small savers who do not need money at regularly interval. For this type of people, the saving deposits is useful. Saving accounts are beneficial to the individuals who would like to save their temporary surpluses, and at the same time they need to have liquidity for payment of their bills like electricity bills or telephone bill or school fees, etc. Some features of saving accounts are they are opened by a large number of people who wish to save a small portion of their income. Then this account is suitable for the needs of the salaried class, then middle income groups or small traders and other small savers. And minimum amount required to open such an account is very small, and the balance required for maintaining this type of account is also small, so it is affordable for small savers. Then next type of deposits is the time deposits. Time deposits are the deposits which are repayable after a certain period of time. In that, first is the fixed deposits. Fixed deposits with the banks are they are called as fixed because they are accepted by banks for fixed period, which is specified at the time of making the deposits. So fixed deposits are accepted for the fixed periods ranging from 7 days to the 10 years. The minimum period for the fixed deposit is the 7 days and the maximum period is the 10 years. The period of the deposit is fixed at the discretion of the depositor. Since the repayment date of such deposit is fixed in advance, the banker is not required to keep cash reserves against such deposits. He can utilize sums collected through fixed deposits in a way to earn for himself profit. Then next is the recurring deposits. Recurring deposit is a category of deposit which is midway between saving and fixed deposits. The rate of interest paid on this deposit is higher than that of saving account and less than that on fixed deposit account. It remains fixed for agreed limit and aims at inculcating among the people the habit of saving. In recurring deposit account, a customer is required to deposit such sum of money for specified period of time on a daily, weekly or monthly basis. Some advantages of the recurring deposits are: it increases the saving habit among the citizens of the country. Then customers can be able to deposit money into the instrument other than saving account, which gives the higher rate of interest, and it encourages customers to make regular savings in the bank's account. Then third type of the time deposit is the flexi deposits. Flexi bank accounts combine the higher interest rates of a fixed deposit and liquidity of saving or current account. Flexi account allows the customers to meet his regular cash requirement, on which he can set a limit and transfer the remaining amount to term deposit and get the higher interest. The next primary function of the bank is the granting loan and advances. It is important primary function of commercial bank. Lending of money is the main source of profit of banks, because without lending, banks cannot sustain in the market because the lack of profit. So here are some types of loans and advances: overdraft facility, cash credit facility, purchasing and discounting of bills, and term loan. Overdraft facility. In overdraft facility, current account holder like businessmen, traders or shop owners, they are allowed overdraft facilities. When customer needs temporary financial accommodation, he may be allowed to overdraw his current account. In this method, depositor is allowed to withdraw an amount of money over and above the deposits with the bank, with the prior agreement with bank. Bank allows the customers to use overdraft facility up to certain limit. Thereafter customer is not able to use the overdraft facility. Then next is the cash credit facility. Cash credit facility is very popular method of borrowing in India. Cash credit facility is an arrangement by which a banker allows his customers to borrow money up to certain limit against a bond of credit by one or more securities. Then next is the purchasing and discounting bills. In purchasing and discounting bills discount is one of the ways in which banks provide funds for working capital required by commerce and industries. So bill of exchange is a financial instrument used for financing transactions in goods that takes some time to complete. Bill arise when goods are bought on credit and payment is to be made at the later date. So bill is written instrument containing an unconditional order signed by the maker directing a certain person to pay certain sum of money only to or to the order of a certain person or to the bearer of the instrument. It is legally safe and can change ownership conveniently. Then last is the term loan. Term loan is one which is granted for a fixed period exceeding 1 year. The repayment of term loan is spread over a period of time and the borrowing party repays it in installments according to the repayment schedule. So there are some types of the term loan: short period, then medium period term loan, and the long term loans. So short period, the loans are up to maximum period of 1 year. Then medium term loans, their period ranging between 1 to 5 years, and long term loans, the period is ranging between the period is more than the 5 years. 5 years, that is the long term loans. So this is regarding the term loan. So here in this lecture we have seen different primary functions of bank. See you in the next video. Thank you.